below that appropriation limit by, I forget how many million. So we're still within compliance. Staff has fixed our calculation error going forward, and hopefully next year we will not have that finding.
Okay. I guess so. It's what?
It's not material. So what it is
Okay.
is there's a very old law that basically makes sure that our we stay in balance with state calculations of our appropriations based on our revenues. And ultimately, it's something you as council actually approve every year as part of the budget process. It's called the GAN limit, GANN. You might remember seeing it, you might not. And ultimately, the factor that the calculation is based on is population. And staff just accidentally used the wrong factor. When we fix the factor to the correct one, we're still well within the state limits.
Okay.
So it's a
calculation errors are never good,
error.
but this isn't a good or a bad thing.
No, correct.
Gotcha.
It's just an error.
Okay, perfect. Thanks.
And I don't have any additional questions or comments. So on that note, our action is to forward to the city council for approval the audited financial statements for this fiscal year. So I'll entertain a motion.
So moved.
Second.
All right. Any discussion? All right. Would the clerk please call the roll?
Chair Burt,
Yes.
Vice Mayor Stone,
Yes.
Councilmember Livcott-Haims. Yes, and the motion carries. Thank you.
Thank you. And thank you to the auditor for not only your presentation, but the audit and for the very positive results of the audit that we received. I want to thank staff for all the work that they do to assure that we're in strong compliance with all the accounting standards. All right, that moves us on to item number 2, which is approval of the FY 2023 annual comprehensive financial report and the year-end budget adjustments in various funds, and a resolution to extend and amend the Development Services Reserve Fund policy, and lastly, revise salary schedules.
Thank you
Ms.
very much,
Ross?
Chair.
Yes.
Next slide, please. So as mentioned by MGO and Ben Lau, we've received a clean audit opinion on the ACFR. It's now uploaded to the city's website for anyone to view. I also want to note that the city received the Excellence in Financial Reporting Award from the Government Financial Officers Association, which is a national professional organization that sets a lot of the best practices that we follow here in the city. Also just want to thank to our staff behind us and also online, MGO, our accounting team led by Rosalind Fernando and her senior accountants, Olga Francisco, Susan Miley, Maria Lagman, and Bonnie Chan. Also our OMB staff, Paul Harper and Desisha Shams. So next slide, please. We've broken up our presentation into government-wide financials and fund financials. We'll start with the government-wide first, which encompasses all of the city's funds. So governmental activities in the general funds, special revenue funds, utilities, internal service funds. So you'll note here that our total net position for 2023 is 1.4 billion, and that represents a 6.6% increase over last year. And you've probably seen the $83 million increase in the newspapers. I just want to note here also in the bar chart on the left for 2023, what's represented here in that 1.4 billion balance is primarily 90% of that balance is invested in capital assets. And the remaining 10% of that balance is either restricted funds, that are externally restricted due to regulations, laws, accounting practices, such as grant funds, development fees, or funds that are within our 115 trust. And the remaining 3.6% of net position represents resources that are not externally restricted, however, are dedicated towards reserves by council policy, such as the budget stabilization reserve or the utility reserves. So I just want to paint that picture here and give folks and viewers a little bit more information on what that amount represents. And then further, right here in the bar chart on the right, we have broken out what that 83 million increase in net position represents. So really, net position is more of a view of, I feel like, the city's like comparable to an individual's net worth. It incorporates like cash on hand plus assets that you have tied up in, say, your property or retirement fund, say, for instance. So within this pie, you see that 2/3 of that increase is related to increases in capital assets. Another third is restricted assets or restricted resources, and the final third is unrestricted. And again, dedicated to council reserves by policy. Okay, I think next slide, please. This slide is a summary of our government-wide statement of activities. And again, this includes business type activities in our enterprise funds and governmental activities. Revenues increased about 23% compared to prior year, and expenses increased 17% compared to prior year. And one of the primary drivers of this expense increase is adjustments for our pension and retiree medical obligations as required by GASB 68 and 75. And we've included description of what GASB 68 and 75 are in the staff report on packet page 55. I feel like it gives you a little bit more description, hopefully in layperson's terms, of what these GASBs and these required adjustments do to these statements here. So those are really the primary driver for expense increases. Next slide. Now for fund financials, governmental activities fund balance total is 321 million. And you'll see in this pie graph that it's split 1/3, 1/3, 1/3 between general fund, capital, and other funds. So overall, within the governmental funds, there was a 6 million increase, which is driven by the general fund, an increase of 5.7 million. And capital project funds increased 15.3 million, and other funds decreased, sorry. Other funds increased by 3.6 million. So next slide. And this table summarizes the general fund budget stabilization reserve. And this can be found on packet page 65. To mitigate risk due to economic uncertainty, council approved a higher BSR target of 20% when the 2024 budget was developed. And after considering 2024, council approved adjustments to the BSR. The amount above the target is 3.3 million. So staff recommends by council policy that the 3.3 million in excess of that 20% target be sent to the infrastructure reserve and the 115 trust. And so after considering 2024 recommended adjustments that will be presented to council in February 2024 during the mid-year budget review, that leaves us with a projected BSR balance of 53.7 million. and that's right on the 20% target. So next slide. And now we're getting into the general fund, just a few historical charts and graphs, and also hopefully that'll be helpful and inform you next week when we talk about the long range financial forecast. This is a view of the city's major tax revenues. Overall total revenues for these tax categories exceeded budget levels by 8.7 million. Next slide. And this view kind of is a more detailed dive of total all revenue categories. And again, on the bottom, we talk about major taxes, which compared to pre-pandemic levels have increased by 13%. And the primary driver of that, although while sales tax and TOT have fluctuated in the 2022 to 2022 years, sales tax has had, or property tax has had major, has had steady increases during that time. And I just want to also keep in mind that a component of that is ERAF. So the city has received 6.4 million in ERAF in 2022. Oh, excess revenue allocation fund. And it is a calculation for, it's always acronyms. It's a calculation for how much of ERAF, how much of property tax increment goes to cities for that are in excess of a certain calculation. Am I describing it right?
Yes, so based on the state budget, they have to fill a certain quota essentially for schools. And once they reach that quota, anything above that turns into what's quote unquote called excess. And then that gets distributed to the counties and subsequently all the recipients. So it does fluctuate based on that calculation.
I think next slide. And this is a budget to actual view of all the city's general fund departments. You'll see here that total expenses were 7.9 million below budgeted levels. And the main drivers of that were non-departmental expense, CSD, and planning development services. Next slide. This is a comparison of actuals over the last 5 years. Expenses have increased 32% since 2019 pre-pandemic levels. Primary drivers of this year's increases were additions to the utility transfer litigation reserve and salaries and benefits due to position additions and contractually obligated pay increases. Next slide. And this is a quick snapshot of enterprise funds net positions. You'll see here that the overall increase in these enterprise funds is about 50 million. And the main driver of that was the payment to the city, payment in favor to the city, totaling 24 million from NCPA's litigation against the U.S. Bureau of Reclamation. So that's it for ACFR results. And the next slide really quickly goes over attachment B and what content is in there. Primarily, these adjustments are broken down into a few categories, and highlighting here, for the most part, many of the budget adjustments are net zero realignments of funds between general fund departments to align budget and actual levels, adjustments to the capital projects for actual revenues and expenses, and an adjustment to TOT revenues and the corresponding transfer to the capital improvement fund for those TOT revenues. Slide. And finally, the Development Services Revenue Fund Policy in Attachment C. This is to support continuity in operations while planning and development services completes a cost of service study. And as part of the study, staff expects to bring forward an updated policy for the council's consideration. Staff recommends that in that time that the council extend that policy through fiscal year 2025. So that then I think they anticipate bringing that cost of service study forward in early 2024. January coming up. And that completes our presentation on this item.
Thank you. So before proceeding to the committee, do we have members of the public who wish to speak?
Chair, we have no request to speak for this item.
I think we have one person in person who wishes to.
Thank you so much.
And let's see, if you can introduce yourself.
Yasmina Boyd, the director and the founder of the United Nations Association Film Festival. And I'm here just to thank you so much, because obviously we succeeded to have 11 days of the film festival from October 19th to the 29th with the support of our city council and your committee, and the decision that was really fruitful for all our community and the filmmakers from all over the world coming to our city. And this is just the gratitude that I would like to give you. The calendar, small gift from our film festivals. It's $5, below $5. So just for you to know, and to tell you that we do have a continuation of our work with the UNEF in libraries. So we are going to have a screening this Thursday and the next Thursday with some of the films from the festival with the filmmakers, and we would love to invite you to join us for that as well. And again, really appreciation and hope that we are going to continue for our next year film festival. The 27th UNEF is going to be from October 17th to the 27th. We already reserved the Mitchell Park for all 11 days. And again, without the support of the city and your committee, we wouldn't be able to do this work. So thank you so much. And I'll give you the small calendars I'm going to put here. So
Okay.
if you have them, and also information for the Thursday screening with the filmmakers. Thank you so much again.
Thank you.
This is also the brochure for you.
Okay.
Thank you.
All right. Returning to the committee, questions, comments, Julie?
Thank you, Chair. Thank you for the presentation. I think I'd like to understand, so the 83.3 million increase in our net position came out last night at the council. It's been in the news, and I'd love to know how we narrate to how that came about, what it means. Certainly better than a deficit, right? But it's complicated. I see you all wrinkling your faces when you acknowledge that we have this much higher net position than we had forecasted. So, or higher position. No? Okay, Kylie, go ahead.
Sure. I think I understand where you're getting at. So help me if I am not answering the question. I think it's really important for both the committee, public, and everybody to understand that that net position is very different than what we talk about when we do our financial planning and our budget actions. So we all sat here, back in May, and we were talking about what are our revenue and expense projections in the general fund? How much of that do we want to bank on and spend? That is not the same calculation as that net position. That net position is based on general accounting standard principles and is a calculation that includes both what I'll call paper money, or kind of like money that you only see on paper, I should say, as well as actual cash on hand that we spend. And what staff does every year when we bring forward a budget is we actually take that number, and or just in general, the financial status of the organization. And we strip away anything that's an accounting principle standard that is essentially an on-paper calculation. Things like your pension liabilities that we expect to be paying over decades as opposed to tomorrow. And so when you strip all of that away, and you really look at your cash or what's your income, what's coming in, and what are you going to spend in a given year, that's a very different number. And so if you were to take that and look at it compared to what we did back in May, we talked about putting, I think, if I remember correctly, something like an additional 8 million in the general fund, right? We said that's going to come from excess revenues above budget and some expense savings. That number is actually comparable to the 3 million that we just said we had in excess BSR. That's the difference, not the 83 to the 8. It's really in the general fund, we had anticipated having an $8 million surplus. We had 3 more million than that. And I'm using round numbers. I don't actually remember if it was 8 from back in May, but that's really the dialogue. So when you think about the 83 million, not only is it not just general fund, it's all funds, it's your utilities, it's all your other funds, but it's also things that are on paper. It's the market value of our investment portfolio, half a $500 million, I think, in our investment portfolio. It's the market value of that. It's the calculated liability of our pensions. Also another, I think, $500,000 number if you do everything. And so it's looking at your financial kind of status as an organization. So you want it to, be a positive number. And the council actually actively works to make that positive. So for example, we're proactively funding our pensions. So what we're doing on an annual basis is trying to lower our liability. And so naturally, when your assets are growing or your liabilities are shrinking, that number is going to get bigger every year. So I think we struggle every year, if I'm being honest, with this idea of how you calculate your statement of net position or basically kind of your financial totality as an organization versus what we use for our annual financial planning. And those two numbers, although we can reconcile them, are calculated in a very different way.
And if I can just chime in on that. So when we look at our budget and we have an annual set of expenses and incomes, that's what we really look at if we have a surplus amount of revenue versus expenses in a given year. And I think what Christine mentioned is really an apt analogy. On personal finance levels or family finance levels, you have an income statement. The IRS looks at your income in a year. They don't tax you on whether the value of your home went up or the value of your 401k went up. Those are your assets. That's not income, nor is it expenses in a given year. And so the whole notion of describing an increase in your home value as a surplus that you received in a year is just fallacious. That's not in anybody's terms what profit and loss is or surplus or deficit is. Yeah. These are mixing apples and oranges and misusing terms. It's not what the government uses as terms. It's not what's used commonly in business, nor in the public sector. It's kind of an invention of calling that difference in your assets a surplus. We do have a modest surplus, but it's not that number. And we should be, we talk about that and how we carry over those dollars. And when we do have that surplus amount, we actually try to have modestly conservative projections on our expenses and revenue. And because we don't want to have deficits. And then we take those funds and typically that balance gets divided between paying down our underfunded pension liability, which is huge, And we're working on a multi-decade plan to address that. And we're doing that more aggressively than most other cities. And additional funds to our capital fund, which is also assets that we need to invest in on a regular basis. But we don't want to budget that narrowly. We budget moderately conservatively under the hope and anticipation that we will have some dollars at the end of the year to add to those because they need more dollars than we routinely give them.
Thank you. And you have teed up my next question, which is first of all, that was very helpful, the explanation. I appreciate it. The general fund budget stabilization reserve ended higher than we want. We want it to be between 15 and 20% of the annual operating expense, and it came in at 21.3. So we have this excess of 3.3 million. And staff recommends half to the capital fund infrastructure reserve and half to the section 115 pension fund. Just there's a typo on page 54. It says section 114. So I thought it was possible it was a different thing, but I figured probably not. Just for when you prepare this for council. So my question is it standard practice that we just split these in half? Is it council policy that we split it in half? If there's one thing I learned from former council member Eric Filseth, it is that we have to fund the normal cost and fund our unfunded pension liability. And so when I see we have excess, my instinct is, shouldn't we be giving more of it to that? Although I do appreciate the capital fund infrastructure reserve needs money too. So how do we decide that each year?
Sure. Actually, it has been a unique practice for us to bring this forward to the committee and council for a decision every year. We've only done that recently. Since COVID, since funds have been so restricted, we thought it should be a policy decision during this time. Council's actual adopted practices are that the city manager has the discretion at the end of the year to transfer any excess funds 50-50 between the 115 and the infrastructure reserve. So technically, so the city manager at the end of the year could have taken this 3 million and automatically done those transfers. However, again, because we've been in this kind of recovery period, we've been bringing them forward out of transparency and doing them at mid-year. I would frankly recommend, as we get into a more normal stream, that we revert back to the council adopted policy. The reason why we put it in both is I think it's a statement of council's priorities through your policy work, that these are both important areas for investment. And so ultimately it is based on that policy that it's split that way.
Okay, thank you. And that's it for me, at least for the time being.
Greer?
Yeah, thanks. Julie, you're making my job easier. You're covering my big question, so I appreciate it. I do want to follow up on one of your questions and Kylie, your answer. So I understand really our surplus is the 3 million. So I don't understand then when we break down the pie chart on slide 3, it shows unrestricted at 28.9 million. So what's that slice of the pie? Because when I saw that, I thought that was the real surplus, but it's not.
Right. And this on slide 3, the 8.9 is citywide. So that includes enterprise funds.
Okay.
Yes.
Thank you.
That slide also, Councilmember Stone or Vice Mayor Stone, that slide is also the accounting calculation that we were talking about, and it hasn't been refined for the specific budgetary calculation that you're used to. And so that number, that 23 million, I think?
28.9.
29 million dollar figure includes, that's your net position. So it includes your assets, your liabilities, so your paper transactions in addition to your cash transactions. Now, Christine, if you can find the slide that specifically calls out the budget, I think calculation that the council member, the vice mayor.
Oh, 6, yes.
So on slide 6, this is staff trying to reconcile the actual BSR the budget stabilization reserve, which is truly the actual funding that the council, should an emergency or other priority occur, can spend tomorrow. Assuming it's not tied up in an investment, but that's different. We're talking about how liquid our money is. But in theory, that is your kind of emergency reserve and reserve that is available to be spent or allocated based on council's needs or the community's needs ultimately. And so we kind of reconcile through where it was, where it is, and where it will be, basically. And so that's the number where you see that 3 million. And that's where you look at the reserve, which you can see is a $50 million number, right? But that $50 million number is based on a target of 20%, right? So it is a large number, but it's within the council's obviously target and goal. And that's the variance you're looking for.
And just historically, do you know, is that the highest it's been since we've established the BSR?
Oh, I don't know in terms of a year-end appropriation of it. You know, because different years have different surpluses. It's always a percentage of your general fund budget is how we measure it. So obviously, as your general fund budget goes up, so too does that reserve go up. So I'm pretty sure your general fund budget this year is the largest this organization has seen recently, in the general fund specifically.
Yeah, more like on a percentage basis.
Oh, this is standard, I would say.
Ah, okay.
This is well within the range of how we typically end the year. We usually end somewhere between 18.5 and low 20s in the percentage of the general fund.
Okay. But yeah, but definitely large budget. I must be the credit to the finance committee. All right.
No.
Another one I was trying to understand. I mean, we went over there, so understand there are various reasons for the increase to the net position, but the report talked about big part of that was adjustments required by the GASB. Don't quite understand how that could lead to such a kind of significant, I guess, how accounting standards can lead to such a dramatic increase. This might be a very elementary question, but
Yeah, it's the Government Accounting Standards Board, and as Ben mentioned, they issue a number of pronouncements periodically. And the specific one that they talk, well, backing up, for the most part, a lot of the standards that they issue are accounting basis, and we're kind of here bifurcating accounting basis and presentation versus budget planning and financial planning. And so one example is GASB 68 and 75, where at the government-wide level, we're required by that GASB pronouncement to book liabilities related to pension and retiree medical obligations, which throughout our planning, yes, we acknowledge that there are those obligations out there. We budget annually for those pension costs, but we don't necessarily book the whole liability into our financial statements. So these GASB pronouncements provide a different view when you're presenting at, say, the entity-wide level. Because really, when we do look at the budget for financial planning purposes, we're looking primarily at the fund level where a lot of these adjustments aren't made. Does that kind of address it?
that helps.
Yeah.
And then this is kind of a bit of a spin-off from Julie's previous question. I mean, it was something I was interested in as well, and looking to the future, trying to figure out more, I guess, accurate projections. But then Kylie, your answer made it seem like the staff's projection was pretty accurate. It was off by 3 million. I mean, is that, I guess, trying to understand within sort of the margin of error, is 3 million good, bad? Is that a way? I mean, is it possible to narrow that?
3 million is scary to me. So it is razor thin. If you think about, you have a general fund budget of about 250 million, and that's 250 million on your revenue side and 250 million on your expense side. And you're trying to project basically $500,000 worth of activity. $3 million is 0.6% of that. So that is a razor thin edge. This is the conversation actually all four of us had back in May, where the council, the committee, and ultimately council chose to take staff's estimates and fully allocate all of it, acknowledging that we may meet them or may not. And so Councilmember Lipcott.
I'm asking a mathematics question.
Yeah, why
You said
is
it's 0.6% of the 250 million general fund, and I'm asking.
Of 500 million. Because if you think about it, when you're making this projection about how you're going to end the year, you're making a projection on both $250 million worth of revenue, and you're making a projection on $250 million worth of expense activity. You have to both project your income and your expenses accurately. And $3 million is 0.6% of those two things combined. So $500 million worth of financial activity that you're forecasting.
Well, let me just say, it's not that we're projecting that accurately. It's that we, with all of the factors, we're assuming that they will average out within that range.
Sure.
Yeah, which is a little bit different. But it's still, I think, out of fairness, what we're really saying is that, and this is what Kylie had emphasized when we approved this last budget, is that we have really narrowed that budget projection range. Now, in most years, that projection is even more conservative than we did this year, and that's why we routinely have a surplus in operations, and we're counting on that surplus to be able to pay for infrastructure and the unfunded pension liability. It's not a surplus and we don't know what to do with it. It is a surplus that we said, if we didn't budget conservatively this year, or if changes happen and revenues came in below what was expected, then we're in a jam on being able to fully fund the infrastructure and the pension liability that year.
Yep.
And that's just kind of the way it's properly done. And this year we cut it closer than we have in the past. And we'll see how that all works out. I will just add that when we look at the budget stabilization reserve, as Julie had noted, our standard is 15 to 20%. We opted to target for the upper end of that range in the budget, and then we came in a little above that. So we're still at the upper end of that range. So even if this year we came in with a bit of a shortfall, we have the stabilization reserve, which we targeted at 20% because we were concerned about economic uncertainty. And the economy has softened. It hasn't crashed. But going forward, we may see a lagging impact on some of the revenue sources like property tax and sales tax. And I would like to just note one other thing on slide 8. When we compare FY 2019 of almost 133 million in major tax revenues versus 2023, it's 13% higher. But what we don't note there, and I think would be very helpful for the council, is and what was the inflation over those 4 years, the cumulative inflation. And I think inflation adjusted, we don't have a real increase, and we may have actually a decrease in tax revenues in that period.
Yeah, I think that's a very fair statement.
Sorry.
Oh, no worries. I just have one final question on what are the implications for Palo Alto if Santa Clara County is audited for excess ERAF like Marin County was. It was kind of vaguely mentioned in the staff report. That was a possibility, but didn't understand then what that would mean for us.
So Marin County is challenging that ERAF calculation. And so what we've been advised by Santa Clara County is to reserve a portion of our ERAF revenues. And within our balance sheet, we've reserved 4.1 million, and that represents 22%, the prescribed range that the county feels are at risk within our balance sheet. So if in the event that we do have to return ERAF funds, hopefully not, we do have that amount set aside for to hopefully mitigate that risk.
Great, thank you.
So basically, we're not spending those dollars at this time. They're on our balance sheet, but we're not spending them.
Set aside, yes.
That's right.
That's correct. And that's consistent. So there have actually been a few ERAF challenges as of late, and it feels like as one is solved, a new one arises. So the council actually has had a reserve in place for a few years now because of these continual challenges to this revenue stream.
And I think that is something we should note, that is a prudent and conservative approach, that rather than spend those dollars, and if it goes, the ruling goes negative, we have to figure out what we cut. We've set them aside and we don't spend them until we know we're going to be able to hold on to them. We have them, but we don't know if we can hold on to them.
And just good to note, that is in the unrestricted portion of things.
Good. And my questions have largely been addressed. One thing I just wanted to bring to our consideration is what Kylie had noted on that prior council policy had been that surplus above the budget stabilization reserve was within the discretion of the city manager on how to allocate it. It typically was allocated in the same way that the council does, but it's millions of dollars. And that stands out to me as an anomaly in the council, not by policy, having the ultimate decision on how that's spent. Whereas on normal budget practices, we have recommendations from staff, and then we have a final decision that's in the council's hands. In recent years, the staff has brought that to the council for their discretion. It was just a question in my mind whether we want to visit whether the right policy is to have it not come to council, or the right policy is the default to council, but with a staff recommendation on how that should be utilized. And so, Kylie, if we wanted to look at that policy, when and how might we do that?
I would say that would be a recommended referral from the finance committee to the full council, that the council would then need to direct staff to review. There's actually two policies. It would be the BSR infrastructure reserve policy, as well as your pension funding policy, both of which determine that 50% of your excess BSR be split 50-50 between those two. So if the council wanted to revisit that and change that the authority, that it is not an automatic that happens, but that the council is to review and authorize that on an annual basis, you would need to change both of those policies.
And so with it being in the city manager's discretion, but how does that align with the 50-50 policy if it's discretionary by the city manager?
I guess it's not discretionary by the city manager. The city manager has the ability to make that 50-50 transfer in alignment with council policy. And so how that would look is actually, as you see all of those kind of year-end true-up transactions that are before you budgetarily to realign things, one of the transactions in there would be actually that 50-50 split. So instead of us waiting until mid-year to do it, it would be in this actual staff report as one of the cleanup appropriation actions. So if we just haven't done that recently out of deference to the council and the priorities, we bring forward the recommendation in alignment with the council policy on an annual basis, but that would just be the difference.
So I'll just say that I've over time felt that 50-50 split is approximately correct, but I can also envision times where if we had a significant, much higher surplus one year, and we had defined needs in infrastructure, or we didn't have those needs and we wanted to pay down the unfunded pension liability, or we want to switch it because we're seeing that the returns on the pension have caused the unfunded liability to go up or down from what we previously assumed, we might want to make a strategic decision there.
You could do it either way.
Yeah.
Not to interrupt you, Chair, apologies.
Okay.
If you left the policies as is with that discretion, the city manager still has to go to the council to fix the appropriations. So how that would look is in your packet tonight, one of the appropriations would be to increase the transfer to the 115 trust and to increase the transfer to the infrastructure reserve. The committee at that time could provide direction that they don't want to do that. And then staff can make the corrective actions at that time in alignment with whatever the committee and council ultimately choose. So I wouldn't say you can adjust it either way, I guess is the point. And so I think that's just a question. If you want to change those policies so that it requires a council affirmation of the implementation of its policies, that is ultimately a change to those policies, or you can leave it, but know that you do obviously always have that flexibility to not approve or uphold or not move forward, put it that way, with the appropriation actions. And so we can absolutely always at that time make adjustments.
Well, I'll just say I like the policy as a guidance, but not necessarily as a formula that we would always follow. And I like the discretion of the city manager to make a recommendation based on that guidance, which the city manager might say, hey, this year we've got a critical need here and let's tweak it. And I like that the decision would be a council decision in an affirmative way. So would we be able to refer that as part of this item or as an end of agenda referrals? How would we procedurally refer to the council for consideration?
I would say that ultimately what this would be is when you refer this, or you would, in your motion this evening, you would say that in addition to approval of this, you would recommend that council refer whatever, insert back to staff. So that when this goes to the full council, council would have to then approve that referral to staff to adjust these policies, or actually it wouldn't be to adjust the policies, it would be to revisit those policies.
Okay. Well, I would like first, before looking to incorporate an emotion or not, what do my colleagues think on that concept?
I really like the idea, Chair. And I think what will be key is for, assuming this does move forward, we need the context of how is the unfunded pension, the Section 115 trust looking, and how is the capital infrastructure fund looking? So we have some sense as to whether 50-50 is right or whether it should be adjusted.
So I would just note that the council has a policy as part of your pension funding policy to review it every 4 years. And you all just reviewed it, made changes to it, and affirmed it.
The policy or the balance?
The funding policy.
I'm talking about what the actual dollars are looking like. In other words,
Correct.
in any given year, if we're considering not doing 50-50, we would want to have the data showing where these funds, how else would we make the decision?
Sure. I hear what you're saying. I caution against that only because that calculation of your pension is going to potentially swing every year based on your investment earnings. Wildly. So that's why part of your funding policy is actually a long-term strategy that's not intended to change on an annual basis. Because what will happen is you'll find yourself chasing the market as opposed to thinking that this is a 20-year thing. And throughout those 20 years, you're going to see wild fluctuations, but the intention is that you stay the course over the long term. So I caution that.
Yep. So I agree that we don't want to be reactive. But still, I think it should be an affirmative action by the council would be my preference. Greer, your thoughts?
Just a question on the current process. Kylie, I thought you said that as of now, the city manager essentially makes the recommendation of the 50-50. It comes to policy and services for approval and then through city council.
Yeah, so I think I've opened a can of worms here. Apologies. The council, your policy, you have two policies. You have one about the infrastructure reserve and excess BSR for that. And you have another policy about your long-term funding obligations. Both of those policies have allocations and set priorities of any excess funds get split 50-50 between those two. And that by that policy or in alignment with that policy, that at the end of the year, the financial transactions to complete that or uphold those policy choices that the council has approved can be done basically administratively by the city manager.
So council doesn't sign off on that as of now.
So council has signed off on it by approving the policies.
Right.
And in order to actually ultimately finalize that transaction, any appropriation action, no matter what, has to be approved by the council. So the city manager would follow the council policies like they would on any other council activity, but ultimately to execute that transaction, the appropriation has to go through council. So that's the stopgap, that's the guardrail. And the council can choose to not appropriate the funds to make those transfers or do nothing. And what I think I'm hearing the chair say is his preference would be, instead of the city manager executing on the policy and bringing that appropriation action forward for the committee and council to either approve or deny, his preference would be that it's always an affirmative approach where the city manager brings a recommendation, and then as opposed to bringing an appropriation that the council then says no to.
Yeah, and the distinction would be when it's at the appropriation level, it's at the end of that process, and we would essentially have to veto it at the very end versus a little bit earlier on, giving any different guidance that we might have in a given year.
I guess I'm in favor of it. I'm just kind of curious how, I mean, I think you made a good point. If we were in a year where it was just a strange year, we had a large surplus and needed these funds directed elsewhere, the city manager currently has the authority to be able to make a different recommendation, correct?
The city manager has the ability to uphold the council's policy of a 50-50 split. However, the city manager can't execute that independently. So that transaction would still go to council for approval. And at which point, if there's an anomaly and the council doesn't wish to allocate it in that way, the council could say, no, I want it a different way.
But I think is your question whether the city manager has discretion to deviate from that 50-50?
Exactly.
No.
Okay. Yeah.
Yeah. So like a few years ago, we had our infrastructure fund get kind of dangerously low because we had major expenditures. It worked out, but that would have been a legitimate consideration of, do we have to halt certain infrastructure expenditures versus adjusting the ratio of that split. Doesn't mean we would have done anything differently, but it's still an important multi-million-dollar decision. Okay.
And and I assume this would just be then probably an action item for finance to recommend to council, which would then hopefully go on to consent. What do you try to understand process in the future?
The referral, how you touched on that, but if you could repeat kind of how this referral would proceed.
Sure. I think we would treat it similar to how we treat when the committee makes referrals through the budget process. And so ultimately the committee would recommend, let's just say you recommend approval of this document and recommend the council refer X to staff, and then council would review the item that the committee's recommended and for approval as well as the referral, and make a decision to either refer it to staff or not.
But I was trying to understand just future agendas. If that policy gets passed, would it look like this is an annual action item for the finance committee
I-
discusses, make a recommendation for council, then to likely go on council's consent calendar.
Sure, I would not recommend this be an annual thing. I think it's just a referral that would happen during calendar year 2024. So what would happen
I
is.
think he means if we adopted the change in policy,
Mhm.
then
we would keep doing this as part of the year-end action and report of the ACFR. Staff would make a recommendation that would then be implemented 6 months later. So if you want to think about your cost of doing something like this, your cost will be 6 months of investment earnings in a 115 trust. Because that's what happens in the delay in the decision. The money will sit in our city's general fund, financial accounting and bank account basically, until we get to mid-year, which happens in February, as opposed to us being able to transfer those funds earlier. So ultimately, that's the just kind of difference. It's a timing thing. And again, if you think about this long-term, 6 months is not going to do a heck of a lot.
yeah, but even that, I need to understand that a little bit better. So, why is it that if it's in the city manager's role to just automatically follow the policy,
Mhm.
that can be done 6 months before it could come to the council? Can you explain, or to the finance
Sure.
committee?
If what happens is if the city, if the policy dictates that this is the authority and ability to do these transactions based on the policy, then what would happen is the staff would move forward with administration of that and just execution of it, which then allows staff to send the money to the 115 account. So the money can be sent to the 115 account and then invested accordingly based on council's financial policy associated with the 115 account. And then you bring back a cleanup appropriation action. If council wants to unwind that and not do that, that's fine. Staff can do that as well. And so we would pull back on the appropriation and basically true up whatever transfers to the trust.
But if as you said earlier, the council already has that ultimate approval on
In an
the,
appropriation action, correct?
why would that timing differ if we were going to actually move it upstream?
Sure. So we're getting into a lot of nuts and bolts in administration of this. So I just apologies if it's getting confusing. Couple things. One, this report will go faster than mid-year. So there's that in terms of the flow of transactions and budget actions by the council. So there's that aspect of it. The second aspect of it is that as staff is making transfers to the trust fund, we do true up adjustments. So we send funds quarterly, approximately quarterly. And so what then happens is staff is able to transfer funds, on a quarterly basis based on the year-end transaction, starting, we could, in theory, if council kept the policy as is, July, August, September, probably as early as October, make some sort of transfer to the 115 trust. And if we knew that it was going to be higher, we would, split that up across the quarters. If council decided to backtrack on that, or they didn't want to uphold it, we would just true it up in a final transfer to the trust fund. So we're talking about cash flow at this point. And time in an investment account. And so we would basically true up whatever those transfers are based on what the council's authority is. And so it's common practice for us to, on transfers, do standard transactions and then do a true up adjustment. It's also what the state does when they do sales tax.
And
so
couldn't that true up be done under this alternative approach?
yes, but the difference would be that the funds would have been invested earlier and then you would invest less later. So again, it just gets back to the whole time in the market.
Yeah, I get that. I'm still trying to understand if ultimately the council even today approves that allocation.
Mhm.
And if we say disagreed with that, it would then have to be adjusted, right?
So you're talking about a transfer, but a difference in timing of potentially October versus March. That's all. Because at mid-year, council goes to mid-year in February, which means you get the authority appropriation wise that you could make that transfer in, say, March. take a few weeks to process it. Alternatively, you do it at the city manager authority as early as probably October. And then you would do smaller transactions in the latter half of a given fiscal year. So again, that's you're just talking between October and March, realistically.
Okay. So do we want to refer this to council for that?
Yeah, I'd support a deeper discussion on
Okay.
it.
All right, so I will move the staff recommendation. Which is to the three parts listed. Forwarding to the council the FY23 ACFR. And second, to amend the budget for FY23 for the various funds in attachment B exhibits 1 and 2. And then third, adopt a resolution to extend and amend the Development Services Reserve Fund of attachment C. And then 4, refer to the council. And Kylie, I'm going to ask you to try to capture the language that reflects what we were talking about.
Sure. See if this is right. And then let me know if it's too fast. Recommend that the council refer to staff review of the long-term. What is it called? It's not called pension anymore. It's long-term.
Retiree benefit funding policy.
Long-term retiree benefit funding policy. And infrastructure reserve. Capital infrastructure reserve. Budget stabilization reserve policy. To amend. For council review of year-end reconciling transactions. I don't know if I got that last part right.
All right, so
Vin, can
we'll
we see
use that. And then you'll have the opportunity. You'll have the opportunity that when it goes to council to have refined that language, right?
Thanks.
Yes.
It was recommended to the council to refer to staff.
Yeah.
Recommend to the council or just recommend that the council?
That's fine.
Yeah.
Recommend
I
that.
think it's a little clear.
Refer to staff review.
Of the year-end reconciliation. Yeah. Does that seem all right?
Why don't we say review of the, oh shoot. Now I know how council feels.
Clarify, would it be BSR?
It's BSR. Yeah, it's the BSR policy for the 50-50 transfer. So to amend for council review of the, so yeah, so I'm trying to be clear because I don't think your intention is to review the 50-50 actual split. I think your intention is that you're referring the transaction kind of approval flow
Yes.
for that 50-50. So that's why I'm trying to be specific here,
Yeah.
because I think if you perhaps just say review the 50-50
Yeah.
split, that's a lot larger than I think your intention
Correct.
is.
Okay.
Okay. One sec.
Just the approval process.
Policy. Yeah, how about reserve policy to review?
On the first line.
Yeah, to review.
The review, the approval process
Review.
of the long term.
Yeah, to review approval process
Up,
of,
Vin, I think it's up, we're talking about after, on the first line, after staff review to interject approval
either one
process,
works,
yeah.
yeah.
Yeah, just right there, refer to the, to staff. Uh. A, review of the approval process.
For excess BSR. Allocations in both the long-term and capital infrastructure policy. Period. Does that sound better?
Yeah.
Uh,
And then we delete after,
oh, I'm sorry, Vin, it would, should be, allocations in both the long-term. Yeah, undo.
There you go.
Yep. In both, yeah, in both the long-term retiree benefit funding policy and capital infrastructure reserve policy, period.
period, and that ends it. Okay,
Thank you.
Thank you, Ben.
um,
Second,
okay. Any other discussion? No? Will clerk please call the roll?
Councilmember Lifcott Hames,
Yes.
Vice Mayor Stone,
Yes.
Chair Burt,
Yes,
the motion carries. Thank you.
great, thank you. That leaves future meetings and agendas discussion of that.
You have one more meeting next Tuesday. Yes, next Tuesday. I'm sorry. The agenda is out. Staff is furiously finalizing the actual staff report. And we will issue them as soon as they're done. So I will email the committee and obviously the clerk will post publicly as soon as they're ready. What is on your agenda is only one item for review, which is the long-range financial forecast. And then there will also be an information item updating the committee on the status of any referrals that have been made to this committee. And so those will be your two items.
Great, sound good? All right, so we'll see, this is, I just want to make sure I have it in my calendar correctly. So this is on the 5th at 5:30. We missed the Chamber of Commerce party, yeah. Well, that might be a pretty quick meeting though, huh? No? What was it?
Just
Oh, it's
depends
a,
on long
it's a
range.
long range financial forecast. No, a single item, but substantive one, yes. Okay. On that note, the meeting is adjourned. Thank you all. Happy birthday, Julie.